Thank you very much, Ryan, and welcome to our special presentation where we're really going to have an interactive digital event with our members here. And our goal tonight is to help answer some of the questions you might have about the AAII Way. And joining me tonight, I'm John Bykowski, president of the American Association of Individual Investors. I'll be acting as the moderator tonight. But joining me tonight is a very special guest, a man that really needs no introduction. But nevertheless, let me give you a brief introduction. Charles, welcome.
Hello, John. Good evening.
Good evening. And Charles, I mean, you obviously are very familiar with our members. You're the editor of the AAII Journal, author of the book Better Good Than Lucky, and really for the last 6 months or so, you've been working diligently on really kind of giving people the steps that they should follow as an individual investor that will really be part of an operating system they could use to help build their wealth. Is that a fair description of the AAII Way?
I think it's a great description. It's going to give people the ability to have some clarity, so when they're hearing all the chatter about the economy and the market, they'll have a plan they can fall back on. That will really be a shining light through all the uncertainty that always seems to exist every time we turn a corner.
So our goal tonight is to answer your questions. And Charles, I think you sent out a survey earlier to people who registered, and that helped give you some basic questions. Anything in particular you want to highlight before we proceed tonight?
We've had some good questions about allocation, about goal planning, so we'll go over those questions. But I will say, while we're going through the webinar, not only are we going to answer some of those questions that came through the survey, but we'll allow opportunity for those of you tuning in to post some questions as well. And John, I know you'll be helpful and pass those along to me.
I'll definitely give it a gold college try there, Charles. And it's again, we've always gotten great feedback from our members, and we're really looking forward to your presentation tonight. In terms of the run of show a little bit, what's your feeling for how we'll be doing our presentation tonight? What should members expect?
Well, we're going to try and mix it up. So I'm going to give some presentations, some slides based on member questions. We're going to integrate the polling throughout the webinar, so you'll see that kind of not really intermission, but you'll see the polling throughout, and we'll be mixing in the live questions. So it won't really be a typical presentation where I'm speaking for a period of time. We're actually going to try and make it a little bit more interactive, maybe a little bit more multimedia in terms of the presentation. So a different format than we've done before, but I hope that everybody in attendance will enjoy it and find it to be a good and worthwhile experience.
I'm looking forward to it myself. So with that, Charles, I'm going to let you go ahead and take control. I'm going to fade into the background here with Ryan, but we'll be ready at any moment's call if you want to ask any questions of our members or if you want to go ahead and do any polls.
Sounds great. Thank you.
All right, Charles, looking forward to seeing your presentation. If you could share your screen, please.
So I'll do it right now. So I have my screen sharing here.
Perfect.
Well, again, welcome everybody. And before I start, I will give a shout out to John. John's been a great sounding board, a great source of ideas as we've been developing out the AAII Way. So he can be modest at times, but he's definitely been a huge help in developing it. So this has definitely been a group effort on the part of AAII Way. I'm going to walk you through some of the member questions. Ryan, John, feel free to jump in along the way with some member questions, and obviously the polls as well. So as John mentioned, we sent out a survey, and many of you who are in attendance responded to the survey. It's very helpful. I went through and tried to pick out some key comments, some key responses, both that seem to reflect what a lot of people were commenting on, while a lot of members were raising questions. And one of the things we asked on the survey was just asking members what they found helpful in terms of staying disciplined when making investment decisions. One of our members, Roger, and I'll only use first names here, said that for him, just having a plan and working a plan. Really well said, and that's really the idea behind the AAII Way, is having a plan that you can follow that actually allows you to make better decisions. So it's really about deciding who you are as an investor, what's important to you, and developing that plan around it, and actually using that to guide your investing decisions. So this really is designed to be a personalized plan. It's not just us saying, here's the strategy, go follow it. We're really trying to help you take these concepts that are based on investing theory, based on academic practice, based on industry best practices, and incorporate it and turn it into a way that works well for you. We want this to be personal. We want this to help you become a better manager of your own assets. And it's a 5-step process designed to help you get there. Very simply, it's about defining goals, picking an allocation, identifying your preferences, selecting investments, and monitoring. At a very high level, it's why are you investing? What's an appropriate allocation given your tolerance for risk? What are your preferences in terms of an investor, in terms of how you want to invest? What are you going to put in your portfolio? And then just having this regular review process where if something changes, then maybe you go back near the top of the 5-step process and work it through. So it's meant to be a living document, not something you do once, it's set in stone, you never look at it again. It's something we really want you to integrate into your financial process. So as Roger said, having a plan and sticking to it. So Roger may well have a plan that works really well for him. We want you to take this framework and develop a plan that works well for you. This is about personalization. This is about giving you the tools to build something that will work well for you. And so what will this encompass? For those of you who are not completely familiar with the AAII process, maybe you've come along some way in, maybe it's your first webinar about the subject. Let me explain to you. It's a series of worksheets that we're unveiling. You can actually go to AAII.com/AAII Way and see these worksheets. Next week, you'll actually see some enhancements to our website that will make it even easier to find some of these worksheets. You also will see commentaries to my weekly AAII investor update. Many of you have subscribed to the newsletter. If not, it's on our website. You can simply click on the latest tab on the website and get to it. This Thursday, I'll be talking about retirement withdrawals and helping people think through some of the tax consequences of those withdrawals and developing that into their plans. You may have also seen these worksheets. We've been publishing them as investor graphics in our journal. You'll see the latest one in October AAII journal, which should hopefully be on our website tomorrow. And longer term, we're thinking about possibly a new book, more fully integrated into AAII, into our website, showing you how you can use different tools on AAII.com to really help you execute your plan. So there's a lot to this. We're still in early stages, but we've already gotten some very good feedback from members, and I hope that you are able to use it to your advantage. So one of the things on here, I want to ask you, one of the things we ask members is what prompts them to review their asset allocation. And one of our members, John, and we actually had 2 Johns tonight that responded, and obviously John Bukowski are moderating, so I want to make clear, different people for all of these. But one of the things he says, he said to him that what prompts him to update his allocation is simply his planning and tracking his spreadsheet and doing his reviewing his allocation at the start of each year. And we really think having a systematic review process is critical to being a good investor, to having that disciplined approach, to knowing what you're going to do. So this is a prototype of a worksheet we're working on, but the idea is for every asset class you have, having a set of rules that govern how you engage in your portfolio. And if I were to design a brokerage website, one of the things I would actually do is just hide the balance. And even though that sounds crazy to a lot of people, the reason I say that is it's really about the process. If you have a sound process, a disciplined process to follow, and you have a way of engaging your portfolio that's process-based, determining what you're going to do when you engage with your process, that's going to help you become a better investor. Our founder and chairman, James Clunan, had 2 rules for investing success. One was to develop a well-defined approach to investing. Rule number 2 was to follow rule number 1. So when it comes time to engage with your portfolio, having the systematic approach where you're not trying to figure out necessarily what your returns were, how you're doing monetarily, but really having this process where you look at your investments, look at your portfolio, and you have specific things you're going to look at. Maybe it's your allocations. Maybe you're looking at your investments, how they compare to the reasons you bought them. So the idea is you have a really disciplined approach when you engage with your portfolio. Now, before I continue, Ryan, I believe we have some polls. We can actually, an interactive poll we can share with our members.
Sure, let me just go ahead and launch that. All right, so here's our first poll. The question is, when have you last reviewed your investment plan? If you are in our chat, please select one of the options and we will see the results momentarily. We're gonna give a few moments to let people vote. And while we wait for the results to come in, do we have any questions that we can take?
Sure. Charles, let's see here. This might be a leading question, but let me see if you have any feedback on this. Is there a spreadsheet to help forecast or just take a look at the income for the portfolio of those of us who are already retired and need yearly income?
So we have a couple things. So we do have My Portfolio, which actually allows you to track your investments. I actually did develop a withdrawal spreadsheet last week to help you kind of track your withdrawals. So really trying to think about what you need to take on withdrawals, thinking about your withdrawal rates. So we do have that available as well onto the sheet. So it does allow you to actually input those things, and it does, and obviously My Portfolio tool will allow you to track your investments as well. So we did release, I do think we released it as a spreadsheet, so you could actually go to AAII.com/AAII Way, download the spreadsheet. And if you're comfortable with using a spreadsheet, try it out. And if you look at it and you say, you know what, this works well, but would make it even better if you did this to the spreadsheet, give us the feedback. You can contact me directly at charles@AAII.com. I would love to hear it, but that's why we're designing these worksheets to actually trying to release them as much as we can in spreadsheet format as well as PDF, so we can get some feedback from members if they see a way to actually improve upon or tweak what we've done.
All right, great. Looks like we have just closed the poll. 78% of our audience chimed in, so thank you. And here are the results.
Great, so we can see here that 59% of the people have said they have actually reviewed their portfolio within the past few months. Some obviously, 10%'s been a long time. So we do have a nice mix, which is not surprising. And certainly seeing so many people look at their portfolio in the last few months is really not that surprising. Obviously, given the level of volatility we had in the markets. And I will say for people, one of the things I talk about when you do have this big market moves, it can be a sign to check your portfolio allocations, make sure they're within targets. For those of you who do Roth IRA conversions, it can be a good opportunity also to take advantage of the depressed market value because you will get more bang for your tax dollars.
So Charles, when it comes to these kinds of rules, and you want to take a look at, reviewing your portfolio, what kind of tips do you give people? Because I'm sure it's part of the 5-step process, but what are the things that you want to do to make sure you do review it at the appropriate time, and when it makes sense to do so?
Sure. So I think there's two things. One, I like using calendars. I think it just puts you on a set schedule and takes the market out of the equation. I personally look at my 403B, which is akin to a 401k. I look at it twice a year, the end of April, the end of October, because those coincide with what historically has been the best and worst 6-month periods. For a lot of people, just doing it on January 1 is a good time because it's an easy date to remember. For people who maybe want to be a little more tactical, you could set a move, say like if the market, moves up or down by 20%, that might be a prompt for you to look and just check your allocations to see if they are within target. Now, if you're holding individual securities, particularly stocks, you want to keep track of what's going on with them. Again, I think a calendarized process, or maybe you don't have to look every day, maybe once a week. And you go in there with specific rules. Why are you engaging with your portfolio? Are you checking the stock's valuation? Are you looking for news on the company? Are you checking earnings? And I know there's temptation to look every day, but I want to point out our model shadow stack portfolio. It gets reviewed once every 3 months. And over the long term, this portfolio, even though it's only looked at once every 3 months, has historically outperformed the S&P 500 by a very large margin. So I think the key is to have a set schedule of when you look. How frequently that is depends on personal preference, but when you go in, have the set key of rules of what are you specifically looking at and what are you hoping to gain from that review process versus just, are my investments up or down?
When we have a major market event, and this year, I mean, it seems like lately bear markets and bull markets have been rapid, sudden, and a lot of things happen quickly. Does it make sense to, at that point in time, take at least a snapshot and see if there's any opportunities? Is not to panic, but really to take advantage?
Yeah, absolutely. Like I said, I think it's a good time to look at your allocations. Certainly, if you have some, money in cash and you're okay to put it back into the market, it can certainly provide opportunities for those who want to be a little bit more tactical. But certainly check your allocations. But for those of you who look at the market thinking, well, how much is down do I need to actually act on? Sam Stovall at CFRA, and a friend of AAII, has done some research, and he suggested a few years ago that people who buy the market when it put money in the stocks, when the S&P 500 falls by an interval of 7%, meaning down 7%, down 14%, down 21%, his math shows they'd actually have returns better than a lot of so-called market timers. And his numbers, there's nothing magical about them. It's just that they really are kind of midpoints between a pullback and a correction and a bear market. And then obviously, if you fall more than 20%, you're in a bear market. But most bear markets tend to be down less than 30%. So then you have that 21 and 28% mark. And the idea is you're not trying to time the market. When you look at history, we know drops of up to 10% are pretty common. Drops between 10 to 20% are not uncommon. Drops of 20% or more are less frequent than those two. So you kind of use those numbers as gauges saying, okay, this is typical and I can act on them. And again, you can change those numbers. There's nothing magical about those, but it is about having that disciplined process versus waiting for someone to go on CNBC and say, now I think the bottom is being set, or now I think it's the time to get in. You're taking that all off the table and having that rules-based process, which again, can give you a good sense of clarity when it seems like everybody else is losing their head.
Well, thank you. I'll keep monitoring the questions here, and then we'll look forward to other slides you have prepared for us, Charles.
That sounds great. And Ryan, John, feel free to chime in when you want to offer a poll question.
Sounds good. Thanks.
Okay, I'll go back to sharing my screen here. Let's see here. Okay, we should be seeing my screen. So let me get back to it. There we go. Okay. Sorry, you all might have been seeing my screen. I was seeing myself. So didn't want an hour of vanity by looking at myself. So one of the other questions we asked was simply, what is the biggest mistake you've made? And certainly I've made mistakes. I'm sure many of you have made mistakes. We try to brush them under the carpet. But one of the comments that Stephen admitted to was panicking and selling in a downturn. That's a pretty common occurrence. People, when markets going down, it is scary, it is unnerving, it can cause you to lose sleep, and it's okay to admit that you're scared. It's okay to admit that you're worried. One of the things I've told people when we've done our investing boot camps at our investor conferences is that if you feel yourself getting nervous, turn off CNBC. Don't go to Yahoo Finance. Don't read the Wall Street Journal. Just walk away. Take a deep breath. Get yourself calm. But the other thing I would encourage you to do is, as you're thinking about your investments, write down how you're feeling. A lot of advisors like to give these risk tolerance questionnaires, and I have one in front of you. And one of the things these risk questionnaires ask people is, well, if your investment fell by X%, how would you feel? And the problem with that survey is how you're feeling on that day is going to determine on how much downside volatility you think you can withstand. So I would encourage you to do is keep a journal, particularly during down markets, and note when you feel nervous, note when you actually do act and write it down, because that's going to be your truest sense of your tolerance for downside volatility. Everyone's psychological ability to deal with volatility is different. We have many AI members that are very stoic in the midst of a downturn. In fact, many look at us for an opportunity. Other AI members get very nervous. And there's a lot in between the spectrum, and there's no right or wrong answer as to where you should be on that spectrum. Just be cognizant of it and take a note of it. That's why on our risk tolerance questionnaire, we do ask what you have historically done during market declines. That helps influence your decisions, and it helps influence the type of allocation you should be following. And I want to encourage you to actually work through the whole risk tolerance spreadsheet to try and give you a sense of where you might fit on the scale of being very aggressive to being very conservative. And once you do, then look at our allocations. And you really want to find an allocation that matches your tolerance for risk. And your tolerance for risk is going to be not only psychological, but also your time horizon, your level of wealth, and the amount of money you need to spend relative to your wealth, and find an allocation that works for you. And a lot of times people will pick allocations based on the return. They might look, well, that allocation gives me a higher return. And if you go more aggressive, you will get a higher return over the long term if historical trends hold. But here's the key about asset allocation. It only works if you're willing to stick with it. So you have to be very clear with your comfort level. And so toning down the risk level a little bit, even though it might realize lower returns over the long term, it might actually help you get higher returns for your own personal portfolio if you're willing to stick with the portfolio. Now, our founder, Jim Clunan, suggested people consider going fully into stocks. And if your goal is to grow assets and you have the psychological tolerance to deal with volatility, that is the best way to grow wealth if we assume historical trends are going to continue. Because we know over the long term, stocks, particularly small cap value stocks, have done the best. But again, you need the ability to stick with that portfolio and deal with that volatility. As Chris Peterson discusses in the October journal, which will be up right, it's a matter of being comfortable with being different. And that varies with each person. So we are giving you 3 allocation models tied to the level of risk you self-identify as being. But the other thing I would suggest is that don't be afraid to hold some safe assets. This is actually an infographic that I used from last week's investor update. But if you're a retiree, think about holding up to 4 years of assets, up to 4 years of living expenses in safe assets, cash, money market funds, CDs. And I know the interest rates are pretty darn awful right now if you're a saver. But the idea is, should the market have a downturn, you have the safe bucket of assets you can make withdrawals from, so you don't have to sell stocks. And from an emotional standpoint, it might just give you the cushion knowing that no matter what happens, your living expenses are covered. Now, if you're working, you don't need as much in cash because you have your paycheck. Then you can think about a shorter period of time. But for some people, just knowing that they have this cushion, this bucket, whatever you want to call it, of so-called safe assets that won't be affected by the market's moves can give them the confidence to take a lot more risk on the equity side. So that's another thing you can use to try and give yourself that psychological tolerance to go after risky assets. But also, if you're in a situation where you might need to take withdrawals from your portfolio, you're also giving yourself a financial cushion as well. But again, the other thing is just having a systematic portfolio review process. And we were just talking about it, having a rules-based process. And the reason, again, is if you find yourself being nervous about the market and you have the systematic approach, it will give you confidence because you will know that you're on this fund's long-term plan and you have a reason to engage your portfolio. And because you've developed it and because you know that we've helped guide you on these best practices from both the investment industry and from academia, it might give you the confidence to stick with your portfolio because you know we have a system in place to keep your allocation on targets. You know why you're investing. You know you're tying your portfolio to your personal time horizon. not the short-termism that you tend to see a lot in the financial media. So those little things can give you that extra confidence to perhaps take a more aggressive stance towards investing than you might have otherwise if you're trying to depend on trying to listen to all the chatter and then decide what to do. It's really about having the systematic approach that you've defined to engage with your portfolio. So let me move on to what parts of the investment process people struggle with. Another question we ask members. Terry asked for help with determining what asset classes and percentages to use. And again, this ties in with our asset allocation models, but it also ties in with your investing goals. So we just talked about being aggressive versus being conservative, but you also need to consider what your investing time horizon is. A big allocation of stocks works really well if you have a long-term time horizon. Over 10 years, over 15 or 20, it will actually give you more of a cushion. But if your goal is, you have this huge chunk of money, say you're looking at buying a new house, maybe you had your eyes on that new Tesla coming out, and you want to pay cash, it's a big chunk of money, and your time frames, say 3 or 4 years, that's not money that should be in stocks. That should be allocated to cash. So you want to think about your time horizon, but I also want to point out for those of you who are retired, if you're in your 60s or you're in your 70s, realize you could still be looking at a couple decades or longer of life. And there have been several surveys. We actually had one appearing in the October Journal where it shows that retirees underestimate longevity risk. So longevity risk is a risk of living longer than you expect. Now, from a human standpoint, I don't know anybody who wouldn't want more years of quality life. But from a financial standpoint, more years of quality life means greater assets, more drain in your portfolio, because quality life obviously requires money to live. So from that standpoint, it's a risk. So even if you're recently retired, realize that although you need money now for withdrawals, you also have part of your portfolio has this long tail that could actually need to grow for an extended period of time. So not only think about when you need to spend money right now, but how long, what is the tail of that duration? How long are you going to continue spending? Because it could easily be 20 years or more if you're retired. And then again, it also ties to your tolerance for risk. So not only your time horizon, but as I just spoke about, what is your tolerance for risk? What type of volatility can you withstand psychologically in addition to financially? And then again, find an asset allocation model that works best for you. Now, you might have more than one goal. And you could think about segmenting your portfolio to different goals. So if you're okay with the complexity, you could actually allocate your portfolio by each goal, so long as you prioritize your goals, so long as you know that goal number one will always come first. And if you see yourself falling short of meeting goal number one, you'll be willing to sacrifice goals number 2, 3, and 4, how many you have, so you always hit your first goal. But you could actually segment it. And for some people, having these mental buckets where this is what I need to do for the short term, and this is what I need to do for long term, just helps them interact with your portfolio better. Is it psychological? Is it mental bucketing? Absolutely. But if it helps you invest better, that's okay. Do so. Now, before I continue, are there some questions, or is there a poll we want to ask members real quick?
Sure. Let me launch into the next poll question. All right, so the question is, what did you do during the recent bear market? Did you buy more stocks or stock funds? Did you sell stocks, stock funds? Did you perhaps rotate to other stocks? Or did you avoid make any changes? We are collecting responses now from the audience. Please vote. And while we wait for the results to come in, John, if we have a question that we can read from our audience, that'd be great.
Sure thing. Let me take a look here. So Charles, this probably has to do with the asset allocation portfolios that you have presented to members here. If they wanted to get information about the standard deviation of those portfolios and how they performed over time, do you have any of that information available?
Yeah, our asset allocation, we actually show how these portfolios performed over worst-year periods, and as we're in the process of revising our asset allocation model, so we'll have those as well. That data is on that. Also in our investor update commentary. So again, I said you can actually go to ai.com/investor-update or just click on the latest tab. That's probably the easiest way to do it. Several weeks ago, I actually wrote about asset allocations, and I actually provided standard deviation for different asset classes, both different categories of stocks and for bonds. If for some reason you have trouble finding it, it's in the archives. Again, they can email me at charles@aai.com. I'll be happy to send you the links for those commentaries.
And we are actually, we're always, we have our managing editor, Gene, who is typically listening quite diligently to these webinars, is probably at home right now making notes. And we always are, when we send out the emails with the replay of these webinars, we will try to include any kind of mentioned links in that email as well. So if Charles, if you have any links to pass on to Gene, we'll make sure that it goes out into the email for all attendees who registered for tonight's webinar.
I certainly will, and we certainly want to thank Gene for doing this each week. It's a great help, and I know our members really appreciate it.
Okay, so I just wanted to share the results with everybody. Here they are. And just a note, because I saw this feedback in the chat, we have approximately 340 people watching us tonight, and about 80% voted in that poll. So 272 folks in total responded to this question. So thank you.
That's great. And it's interesting. I'm looking at the results right now. So 39% said they bought more stock funds. 39% said they avoided making any changes. A few months ago, I want to say it was the May issue, we actually did a big question surveying AAII members about what they did in reaction to the coronavirus bear market. And these percentages are pretty close to what we saw, where we saw some people taking opportunities, other people holding on to their assets. And so there's this notion about individual investors somehow being scared, not being opportunistic, always being fearful. Occasionally hear someone use the slanderous term of dumb money, but you can see here, AAII members are pretty disciplined, and even a bunch that realizes that when they see an opportunity to take advantage of discounted prices, they're going to jump. So very disciplined. Certainly, throwing a sledgehammer into this perception that some people like to convey. And I think it's really important to say that when you hear the professionals calling the individual investors dumb money, when you look at some of the things they do, they're not exactly smart. That smart money misnomer is really not true. We actually do see a lot of AAII members being more disciplined and making more rational decisions than I hear some professional investors doing. So, kudos to all of you, for sticking with your plans. We always love to see that members are engaging and actually making themselves better managers of their own assets. Got any more questions before I continue?
Just a quick, I'm not sure if it's a quick one or not, but I see quite a few questions from members asking about selling rules and any kind of advice or tips or processes that investors should follow when determining whether or not to sell a security.
I'm actually going to get to that in a little bit of my presentation. I'll actually give you some ideas about how to actually develop rules for stocks and for bonds. I will say in terms of allocation, though, real quick, in terms of making allocation adjustments, it's really just about, I think it's helpful to have bands. So if you're looking at allocation, decide how much you want to let your allocation swing. So if your allocation calls for 60% stocks, 40% bonds, from that standpoint, when you start selling stocks, putting money into bonds, or vice versa, think about how much off target you want your portfolio to go. Vanguard's done some research, and they suggest using a 5 or 10 percentage point band. So if your goal, say, is 60% stocks and it gets to 66 or 71% stocks, maybe then you pull it back into it. If you're going more aggressive, Jim Clinton's level 3 approach, he didn't worry so much about allocation as much as he suggested just having that up to 4 years of cash. So you could think along those rounds as too, in terms of, I just need this much for my living expenses. But I think the big key is just to set some boundaries in your allocation and say, if it goes off kilter X percent, then I'm going to rein it back in.
Excellent. Well, if I'll let you continue on with your presentation. I've got lots of questions. We'll save room for the time at the end of our presentation to answer additional questions that come up then.
That sounds great. Okay. And by the way, I do appreciate you all participating in the live polling. I think it's great. This is the first time we've done this, so I'm glad to see you all are engaging. We find the feedback useful. So I do want to go into another question we asked, which is what parts of the investment process do you struggle with? Linda wrote in, challenging to know what stocks to buy and sell. So we just got asked about buy and sell rules. And there's a couple ways to think about this. One is simply write down your portfolio composition and your rules. One of the things we really think is key to doing this is to just know why you're buying and what would prompt you to sell. So chances are many of you have a strategy you follow. Maybe it's value, maybe it's growth. Perhaps some of you watching are using technical analysis. The idea is to actually write down how you're going to manage your portfolio and what you're going to use to actually pick your stock. So perhaps you're using the AI stock screens, and that's going to help govern your rules. Maybe using one of our model portfolios. Maybe it's a model shadow stock portfolio. Maybe it's our VMQ stocks. Maybe it's dividend investing or stock superstars reports. Have that written down. This is why I'm doing it. If you're going to use funds, then keep track of the objective and why you're buying the fund. Maybe you're buying the fund because it's following a specific strategy, and you see that strategy change. That would put that in your notes as to what would cause you to actually hold that fund. So the idea is to really be clear about why you're buying investments and also what makes it attractive to you. So now we do have this on here. I do want to make a shout out real quick to our My Portfolio tool on AAII.com, because on that portfolio tool, we actually have a notes field where you can actually write notes by each individual investment as well. Now, in terms of rules for stocks, I did talk a little while ago about allocation. For rules, if you're not sure what your rules should be for buying or selling stocks, you can start by just looking at our model portfolios. In front of you, you'll see the rules for a model shadow stock portfolio. This is started by Jim Clunan. It's now being overseen by John Mikowski with assistance by Wayne Thorpe. And the reason I'm pointing out to you is you can look at our rules. Now, this is a deep value small cap portfolio. We're looking for the cheapest stocks and also the small stocks among exchange listed stocks. So you can see here where we're looking for price to book ratios of less than 0.9. We're looking for market capitalizations of no higher than $300 million. And we want them to be profitable. So if you're trying to develop your own rules and your goal is to look at small cap stocks, you could take from these rules and say, okay, I like some of these rules. I'm going to incorporate them into my rules. Now, for the shadow stock portfolio, our sell rules are just the opposite of these. So we sell a stock when its price to book gets to more than 2.7 times price to book value. That's simply 3 times our initial buy criteria. We'll also sell it if the market capitalization gets above $900 million. So the idea is our sell rules are the opposite of our buy rules. So you could look to our portfolios to give you some guidance if our portfolios have a similar strategy to what you're trying to implement. But if you choose, you're welcome to choose follow our model portfolios. But if you want to do it be more of a do-it-yourself portfolio, you can use these as guidance to develop your own personal rules. You can also look at our stock screens. So this is actually for our Dream with Estimates revision screen. I just picked a screen to kind of give you all an example of what to do. This is actually looking for, again, it's a value-oriented strategy, looking for price to earnings ratio in the bottom 40%. So if you're using an A-plus investor and you see our grades, you could be looking for stocks with value grades of A or B. It's a broader valuation measure, but same type of thing where you're looking at the cheapest 40%. He's also considering debt measures, also looking at earnings estimate revisions. So the idea is you can look at these stock screens. You can find screens that match your style of investing. So if you're a growth investor, you can find our growth screens. If you're a value investor, you can look at our value screens. If you're a momentum investor, you can look at our momentum screens. And you can either use our screens, or again, if you want to develop your own approach to investing, then maybe you can use these to give you ideas for what your buy and sell rules should be. So maybe you borrow a little bit from this strategy, a little bit from that strategy and you create your own rules. That's totally fine. Of course, you always can just use our screens. And if you use our screens, keep in mind, our over 60 stock screens, these are just basically filters. It's filtering the universe of stocks for stocks that have the specific criteria of these screens. They're not managed portfolios. So it's up to you to determine what your sell rules will be. But it really is, you could simply do it as, okay, I know the screen's looking for value, looking for positive estimate revisions. And so just think about what the opposite of that might be, and that could actually be your sell rule. So again, you have the ability to use our managed portfolios, which are actually actual portfolios, where you can actually look over our shoulders as we're managing these portfolios. Or if you prefer more of a, you know what, I want to do things myself, borrow from them, borrow from our screens to help design your own rules for investing. Now, I do want to go back into real quick about the idea of biggest investing mistakes. JB said he regretted putting more money in the market earlier in life. And I've heard that from other retirees too. Geez, I wish I'd started earlier. And certainly those of you with kids or grandkids, we'd love to have them join AAII. We think we have a lot to offer, so please share the magazine with them. We encourage you to talk about AAII with them. But again, I also think it comes down to focusing goals and timelines. I've read surveys about millennials being really conservative with their portfolio. And if you think about someone who maybe started investing, you know, entered the market say in 2000, they saw two bad bear markets, you know, saw a housing crisis. You know, maybe people who actually, kids are growing up, they're now as adults, you know, the last decade, maybe they saw their parents struggle. And so you can see where you have a generation that might be more conservative. The problem is they're not thinking about their goals and their timeline. If you're 20 or 30, what's going to happen today, tomorrow, next year really doesn't matter because you're looking at 30 or 40 years of lifespan. Now, say you're a recent retiree, again, you could be looking at another 20 or 30 years of life. So you really want to think about what your time horizon is. And if it's long, you really want to take that risk on the equity markets because your biggest friend is time. And if you don't get into the markets, particularly with a more aggressive allocation, then time becomes your enemy because you're not using it to your advantage. Now, again, if you have a shorter time horizon, that also affects your investment. So obviously, if you have a short time horizon, you have less time to grow your assets. You want to be more concerned with asset preservation. But again, it really comes down to thinking about what your time horizon is and tying your allocation with that time horizon.
You know, Charles, we do have a question that we do want to poll the audience on,
Sure.
in terms of, you know, we're talking about rules and goals and time horizons. So go ahead and launch that.
Yeah, please do.
What has the biggest influence been on how you allocate your portfolio? Is it your tolerance for risk? Is it your desire for return? The market conditions, whether they're current and or expected, the macro environment, you know, these are things that we're talking about like the economy, or some other reason. Let us know by responding in the poll now. And while we wait for the results to come in, John, do we have some questions that we can fill the time with?
Sure, definitely. Well, I've got a question here from Thomas, and it has to do, you know, it's probably more of a technical question, but it has to do with things like insurance and federal insurance. And if someone has a lot of money invested and he's concerned that, you know, he might limit, you know, there are limits as far as how much is covered through federal insurance on your bank. How does one concern themselves with brokers versus banks and how they allocate their cash investments as well as, you know, their holdings?
You know, that's a good question. So there are limits imposed by the FDIC as far as how much is covered. They've changed them. I'm going off memory. I want to say it's $250,000. And off the top of my head, I can't remember what the rules are per account and per bank. So I don't want to quite comment on that. I'll give Gene a link to the FDIC website on that page where they explain what it is. On the broker side, so there is the SIPC that actually protects your accounts really against theft. So if someone were to go in and steal your accounts, they have to replenish it. And I do think there is actually some coverage for cash as well. I don't want to say that for certain. Again, I can give Gene the link to that page where it goes over the rules on it. But obviously, if you're concerned, it may make sense to open accounts at different institutions. But particularly if you're looking at banks, make sure that FDIC insured. And I would say also be cognizant of the yields. I'm sorry, the interest rates. If you're seeing unusually high interest rates, you really want to dig deep because you want to wonder why is it so much higher. To give you an example, last weekend I was looking to see what the national rates on savings were. Most of the top, according to bankrate.com, most of the highest yielding online banks were about 0.6%, 0.65%. We do have a relationship with Discover. You can actually get above average rates with Discover. I think Discover right now is paying right about that 0.6%, which sounds low on an absolute basis, and it is, but relative, that's actually one of the highest yields. So if you're saying that's a national average and someone's saying, you know what, I can give you 3% on your savings, that would be a sign to stop and ask yourself, why is it so high? What guarantees on it? And really kind of grab your wallet a little bit tightly before you investigate. So that's one caution I would just put to everybody. And I do realize for savers, the low interest rate environment is painful because certainly what you're making on your cash right now is much lower even than what you were earning at the start of the year.
So while we're talking about why people allocate their portfolio the way they do, here are the results of the poll. We had about 279 people participating in this poll, so thank you. Yeah, Charles, any comment on this?
No, I think it's actually not surprising. So, you know, evenly split between their tolerance for risk and desire for return. And obviously investing is always about risk and reward, trying to find that balance. And so we see two people doing it. And, you know, really at 5%, really just, you know, letting the macro environment, you know, really determine their allocations. And we don't know how many people of those are actually, you know, more tactical in approach, but we do see people really thinking about, you know, what do I need for return? What do I want for return? And also people considering their level of risk. And obviously, I think if we allow multiple choice, we might have seen people possibly selecting both as a possibility as well.
Great, thank you.
When it comes to things like your asset allocation, I have a question here. How does real estate come into play as far as allocation is concerned?
No, that's a good question. And I do think there's a difference between if your real estate is rental or if you're looking at REITs, real estate investment trust. Real estate investment trusts are equity investments. The returns are really between small cap stocks and large cap stocks. So I would consider those to be equity. They don't necessarily fit in nicely with our asset allocation models. If you want me to plug them in, I'd probably say perhaps in terms of mid cap. So they are equity investments. If you own real estate, then it's a little bit different because now you're dealing with an asset that's not as liquid as stocks. You're not getting updated prices. You know, if you held a stock, you held a REIT, decide you don't want it, you can log on your brokerage account, generally within a few minutes under normal market conditions, you can sell and you're out. If you own property, mineral rights, water rights, then you're not getting constant pricing on it and it might be hard to sell. So that's more of an illiquid asset. Now, technically it is equity, but you do want to consider about how safe your stream of income is. So it really falls outside the typical asset models because you might have something that might be providing you a very steady state of income. If that's the case, you feel pretty confident about the state of income, that flow of income, you could treat it as more as somewhat of quasi-fixed assets. But if it's something that might be more prone to economic swings, perhaps you have rental real estate turns over quickly, then it might be a little bit more equity oriented. So again, it doesn't fit in necessarily really nicely into a traditional asset allocation model, unfortunately.
Okay, just one quick follow-up question, and it's sort of related. So if a member here, if they have money that's coming from a defined benefit pension, can that be treated almost as a bond equivalent?
Yeah, absolutely. The way I look at it, even on a risk questionnaire, we talk about guaranteed income, and I've used the sorts of guaranteed income. So I loop that in with Social Security, annuities, and really the more you have in sources of what we'll call guaranteed income, and obviously there's always a risk with the pension, there's always some risk with annuities, but they're pretty close to being safe or close enough for purposes of allocation. That allows you to take more risk. So the more your expenses are covered through sources of income that are reliable, the more risk you can take, and really the more aggressive you can be with your portfolio. In fact, a friend of mine, Michael Falk, wrote an article for us several years ago where his view of retirement was cover all your expenses with guaranteed sources of income, these sources of income, and then everything else doesn't matter. Now, Michael's a friend of mine. We do disagree about different things, but it is a bond-like type of source in terms of asset allocation, in that it gives you more ability to buy stocks because you can depend on that cash flow. And if that covers all your living expenses, and say you're in retirement, then the choice to allocate for stocks is really comes down to your psychological tolerance. Unless you want to allocate some extra money for vacations, maybe some other big expenses, because your living expenses therefore are going to be mostly covered or possibly are completely covered.
Excellent. Well, I'll let you continue on, Charles. I'll be watching the questions here for additional things to pop up.
That sounds great. Thank you, John. Let's go right back here to my screen. And there we go. Okay. So another question we asked is, if you were to create your own personalized investing plan, what would you want to include? So we had another member named John. So again,
Charles, I think you turned off your display.
Oh my goodness. Oops. Okay, there we go. Sorry about that. Technical difficulties. So again, we had another member named John who wrote into this question about if we were to create a personalized investing plan, what would you want to include in it? John wrote goals and timeframes for each goal, and then for each goal, really breaking down the strategy for each. And so I did talk about earlier about this concept of having a bucket-like approach, allocating for each goal. So again, this does layer a level of complexity in your portfolio management process. So there's a personal preference as to whether or not you want to have the complexity, but you could do it. And so in investing, there's this concept known as core and satellites. So core is the main part of your portfolio. So for instance, say the main part of your portfolio, primary goal, say, is funding retirement. That perhaps is the largest part of your portfolio. But then maybe you want to fund your grandchild's college education. Maybe you're looking to leave an inheritance. Perhaps it's a charity or a congregation you want to leave money to. Perhaps you want to have a splurge fund. Each one of those is a separate goal, and you could create a separate portfolio strategy for each. So how would this work with the AAII Way? What it would do is, for each of those goals, you would actually work through the process for each one. So you would actually have different investing plans. So again, like I said, it would add more complexity, more paperwork, but then if you have the ability to do so, you could actually manage different parts of your portfolio separately. And while all your accounts and all your assets do contribute to your overall wealth, it does allow you to achieve different goals. Now, and again, with the caveat that if you have to assign priorities, if a higher priority goal means sacrificing a lower priority goal, then you'll have to make those adjustments, but you could very well do that. So it's like John said, basically, in that you actually go through each of these goals and you tell your strategy for it. So it's really a case of starting off with this basic worksheet of what are my goals, and for each goal, working through the rest of the process to actually achieve those goals. So you have separate strategies for each. And it may be actually helpful for you to have separate accounts. So perhaps, separate IRA accounts, separate, traditional brokerage accounts. It all depends on what makes it easy for you to separate each account. And I'm going to use that word complexity again because it does layer on more things and how comfortable you personally are. Now, I will say, if you are doing this complex, or you are using this core and satellite approach, make sure you have everything written down. So if your spouse or your heirs needs to step in on your behalf, they can pick it up and see exactly what you're trying to do, versus just seeing a list of accounts or a bunch of different investments and them trying to figure out what you're doing. And even if you just have one account, having that written plan in your estate that these are my accounts, this is my investing plan, here's what I'm doing, it makes it a lot easier for your spouse or one of your heirs or someone else you trust to step in and make the decisions you'd want them to make should something unfortunate happen to you. And now, before I continue, Ryan, is there another poll we want to ask?
Yes. So speaking of complexity and mix of assets and all that, we wanted to launch into this poll, which we wanted to figure out what type of investor our audience is comprised of. Are you a fully hands-on investor, meaning you individual securities only, partially hands-on, meaning your allocation is mixed with stocks and mutual funds, ETFs, an index investor, perhaps your portfolio has passive mutual funds and ETFs only, a fund investor, which means that you would have actively managed funds, or are you a combo hands-on investor, or slash you work with an advisor investor? All right, we're going to keep this poll open for a little bit and find out what kind of investor comprise our audience. John, do we have any questions to pipe in?
Sure. Charles, any thoughts about how preferred stocks might come into play for income?
Yeah, that's interesting. You know, preferred stocks, they're a hybrid asset, but they are an equity investment. You know, Benjamin Graham talked about preferred stocks, and you know, one of the things, he wasn't a huge fan of them. So preferred stocks, for those of you unfamiliar with them, they're equity investments, but they have priority claims on dividends. So when dividends get paid, they actually get paid to the preferred stock first, and then to the common equity, which is what we typically think of as stocks. So they can provide a higher level of dividends. Those dividends are taxable. There are qualified rules for them, and I'm going off memory, but I want to say versus common stocks, where it's a 60-day holding period, I believe preferred stocks have a 90-day holding period around the ex-dividend date. So it's a tax consideration people need to think about. But they can provide a source of income, but I'd still group them more on the equity side, even though they might be a little bit less volatile than common stocks. When you look at the claim on assets, bondholders get paid first in the event of bankruptcy or the event of financial duress, then preferred stockholders, and then common stockholders. So in an event of a bankruptcy, and certainly we've seen several retailers go under. I think the Wall Street Journal used, I think the number said 27 retailers have filed bankruptcy so far this year. If you're holding, you know, preferred stock in one of those companies, you might have actually seen your stake being wiped out. So from a risk standpoint, they're probably a little bit more like equity, even though they might provide more income than a traditional stock.
There's almost a cross, almost a bond that has no maturity, and
Yes.
there is some elements as far as, I mean, the benefit to that there is no maturity, but I guess because of that, the volatility is in there with interest rates and the risk of the company itself being able to pay that off. The other part, I mean, in some cases, if they do miss payment on preferreds, in some cases, based upon the covenants, they may have to go back and pay those past dividends. In other cases, not. So it's always important to do your homework when you are investing in a specific security that way, to see whether or not it is going to go back and pay any missed dividends or not. Ryan, would you care to share the poll results?
I do. So we had about 79% of our audience coming in, about 245 people, and looks like the majority of our audience tonight are partially hands-on investors, so stocks, mutual funds, and ETFs.
Yeah, again, not surprising. And we talked about it. You know, I myself own stocks, but I use funds, and certainly if somebody has a 401k, they're going to be obligated to use funds. But for a lot of people, when you look at the bond allocation, for a lot of people, it's just easier to use bonds. For those people investing internationally, a lot of times it's easier to use an ETF or a mutual fund to actually do that as well. And there's no right or wrong answer. It really depends on your comfort level. For those of you who do have funds, if you haven't looked at our fund section, our ETF section on AAII.com, take a look at it. We've really enhanced our offerings on both for mutual funds and for ETFs.
And it's probably fair to say that whether you are working with an advisor or doing things on your own, either way, you're going to have to go through the process. And the best thing is to come up with a overall investment strategy, come up with your risk profile, determine your asset allocation, and then whether you do all that on your own or with an advisor, the steps are the same. And really, if you want to succeed long term, you need a process in place. I mean, you could by chance you could do well, but if you want to try to ensure that you're going to meet your long-term lifetime goals as far as wealth accumulation is concerned, having a plan in place that helps dictate your actions, whether you buy, sell, or when you do your reviews, all that is just going to help make sure that you don't panic at the wrong time and that you have a realistic appraisal of what you can build up over time and where you stand now. I mean, I think that's probably, the issue is having a system in place. And that's what we're really talking about with the AAII Way. Would you say, Charles?
Yeah, absolutely. It's well said. It really is about having that plan and really having a well thought plan that's personalized to you. In investing, there's no one size fits all approach. And so you really want to make sure things are tailored, rational, and systematic. Great. Are there any other questions?
Oh, well, Charles, I just wanted to note that we are running a little bit long, so I wanted to thank everybody for staying on with us. But if you wanted to go ahead and take a few more questions, and then we can talk about the future of the AAII Way
Yes,
Way project.
I have one more poll that I think a lot of our members would be interested in seeing. And
sure.
So John, do you have any? Yeah, do you want to do questions first, and then we'll go to the poll?
Sure.
Well, there's a ton of questions here, so I mean, depends. You tell me what you like, Charles.
Now, why don't we do one question, and then we'll show the poll?
Sounds good.
Very good. In terms of inflation being an issue, are there any strategies that one should consider to help hedge against the risks of inflation going forward?
That's a good question. Stocks over the long term are really the best hedge against inflation. Over the long term, stocks have delivered the best returns against stocks. You get compensated for inflation because obviously with inflation, you will see sales and earnings grow. And so that's really your best hedge for it. A lot of people like to talk about gold as being a hedge against inflation, but it really depends what period you're measuring gold over. And depending on the time period used, gold can look like a terrific inflation hedge, and it can look like a lousy inflation pledge. Obviously on the bond side, there are inflation protected securities tips which are offered by the Treasury Department. You can buy those directly. Those do adjust relative to inflation, but right now, obviously, we're looking at the rate of inflation being really low, and it looks like the Federal Reserve is going to keep interest rates low for a long period of time. But I think for those who are concerned about inflation, it really comes down to just holding stocks over the long term.
This is a question that has to do with the determining one's risk profile. And there's a very specific question in there that asks, how much are you dependent upon non-portfolio income, or how much non-portfolio income do you get as far as your living expenses are covered by that? And typically speaking, I think as far as the question, one where you're spending, how much of your spending where equals none is one. I'm not sure if you're gonna put that slide up or not. I believe it was pretty early on. They feel like perhaps being penalized for having a larger portfolio. Any thoughts to that?
Yeah, no, actually, I mean, if you have if you have a large portfolio, a lot of your living expenses are covered. That actually is I get a lot. I try to get the word here. It allows you to be more aggressive with your portfolio. So the more you have, or really, it's not even such the more you have, but the less you need to withdraw from your portfolio relative to your wealth, the more aggressive you can invest. Now, the more you need to withdraw relative to your wealth, it actually means you should be more conservative because it means you have less of a cushion. So if a bad bear market happens, your portfolio drops, but your living expenses are pretty fixed, you're going to be taking a higher proportion out of your portfolio. So that's where the relation of wealth comes. The less proportionately or less percentage-wise you have to take out of your portfolio to fund your living expenses, the more risk you can take, because the volatility of that portfolio is going to have a smaller impact on you. Versus the smaller your portfolio, the less volatility you can handle, because you might actually you're not be able to withstand that blow to your portfolio perhaps.
So I'm going to go ahead and launch the next poll here, and this is kind of for fun, but we're interested in people's responses. This project has been named the AAII Way, and we just want to know what the official name of this project should be. Should it be the Individual Investor Wealth Building Process, the AAII Way, or the Individual Investor Manifesto? Please vote now, and while we wait for the results to come in, we can go ahead and continue with the Q&A.
Very good. Let's see here. So in this case, a lot of the rates of return are based upon assumptions or observations over the long period of time. And if you're in retirement and you have potentially risks as far as being caught in a bear market at the wrong time, does one look at the allocation differently if they're in retirement versus accumulating for retirement?
Yeah, that's a really good question. And I talked about some at boot camp, and I actually have a slide. I don't have it here to show you, but basically, if you look at opinions as to what people should allocate to equities at retirement, it ranges from over 90% to down about 20%, and everywhere in between. So if you get 5 retirement experts and you ask them, how should I allocate to my portfolio at retirement? Among those 5 experts, you're likely to get 10 answers. So I do want to point out there is zero consensus about it. Jim Clunan actually recommended people start building a cash bucket leading into retirement. We've done studies looking at allocations from 0% stocks, 100% bonds, to 100% stocks, 0% bonds. And I've looked at it over decades. And really that range, and I didn't use Jim Clunan's, we're going to retest with Jim Clunan's level 3 approach, but really this range that if you're between about 70, 80% stocks, 20% bonds, down to about 40% stocks, 60% bonds, chances are over most retirement periods, as long as you have a reasonable withdrawal rate, you're actually going to be fine. Now, where we do tend to see retirement portfolios fail, most often it's because bear markets happen early in retirement. But it's worth noting when you look at that range of really 40 to about 70% stocks, 8% stocks, as long as you're using a reasonable withdrawal rate, say 4% over a period of 30 years, most of the time you're not going to run out of money. And that's a 4% withdrawal rate that we adjust upwards for inflation each year. Your success rate of never running out of money is really in the high 80s, low 90s, so pretty high. Jim Clunan did his own research when he's running level 3, and he looked at having up to 4 years in cash. And he found out that if you have to set up 4 years of cash bucket going into retirement, and then anytime the stock market's more than 5% off its highs, you withdraw from that cash bucket, and the rest of the time you withdraw from stocks. He actually found that's highly successful. And Jim actually wrote in his book, I think all you really need is 3 years in cash, but I wanted to give people an extra cushion, so I suggested 4, and they could actually go up to 5 years if they want to be a little bit more conservative. So Jim's analysis found that if you go very aggressive with your portfolio, but you have that cash bucket, you can actually be pretty aggressive with your portfolio in retirement. But I do want to say again, if you ask this question to somebody else, you might get a different answer, because there is absolutely no consensus on what people should do at retirement. Like I said, our methods are based on academic research, based on our own analysis, based on research like William Benjamin, who came up with a 4% rule. So we feel pretty good, but there are other opinions that are out there.
In terms of a couple of comments here regarding their IRAs and RMDs, their minimum required distributions. If you've been diligent in saving up and now you have big IRAs, now you're forced with these annual withdrawals, any way to help ease that pain?
It's not easy, and I wrote about this for tomorrow's investor update, so it'll be in there. So you're right. You're forced with these RMDs. They're required minimum distributions. You have to take those year after year. So your only options are to do a qualified charitable donation, a QCD, where you're donating money to charity. Now, if you're a charitable type and you're planning on donating to charity anyway, I would suggest using those QCDs because it reduces the amount of RMDs you need to take each year. So it actually lowers your taxable income right off the bat. And you might actually want to think about what might actually qualify. My father, for instance, uses the qualified charitable donations to actually, donate to his congregation, which he would do anyway. But this way, he's getting that immediate tax break by doing it, and it does count as a qualified charitable organization. Now, short of that, you could also do a Roth IRA conversion. You'd pay the taxes up front, but then you wouldn't pay the taxes again afterwards. And so if you're worried about passing that tax impact onto your heirs, it's one thing to do. But in doing this, and I am writing about this tomorrow, you want to consider what the impact of that Roth IRA conversion will do in terms of bumping you up to the next marginal tax bracket, but also will increase the amount of Social Security benefits you have taxed. There's a threshold that takes you from 50% up to 85%. And then your Medicare Part B premiums, because your Medicare the conversion you do today could actually affect your premiums 2 years from now. So we're in 2020, if you do a Roth IRA conversion now, it'll affect your Medicare Part B premiums in 2022. So you do have to balance that all out, but you could split those Roth IRA conversions over a period of years. Unfortunately, you still have to pay the taxes. So if your goal is to avoid the taxes, there's not a whole lot you can do, but at least maybe you can spread out over a period of years, or perhaps you're avoiding a bigger tax bite later on because your RMD rose and that pushed you into a higher tax bracket. Or obviously, should something happen to marginal tax rates when they're set to sunset at the end, I believe it's the end of 2024, at the end of 2025, the tax rates are set to revert back to the old ones if Congress doesn't do anything.
Let me ask one more question here before we kind of end with Ryan there. Mm-hmm. A couple of questions that have come up here with people who have either, they have dry powder to invest, or they've come into some cash and they want to invest now. And the questions are very similar here. I've gotten from members here. A, do they wait for like a market pullback, put all their money in at once? Do they rely on some sort of value averaging or dollar cost averaging method? Any thoughts on how one should go ahead and invest in the market if they have money to invest?
Jed, that's a really common question. So I get that. I also get people who are pulled out of the market and ask, how do I know when they get back in? What I tell people is it's really hard to forecast the markets. But if you are concerned about putting it all in at once, then yeah, I do think the dollar cost averaging or value dollar averaging approach, and we talk about both in the October AAII Journal, not to plug the magazine again. But the other option, a very simple approach, is circle dates on your calendar. So maybe it's every month, maybe it's every 2 months. Just circle those dates on the calendar and just put money in each of those dates. Now, are those dates arbitrary? Yes, but versus putting in your money on Thursday versus 2 weeks from now, well, that's also arbitrary. Or looking to, because you expect the markets to maybe do something on election day, well, it's all arbitrary. But if you set certain dates, at least it's systematically going in. So you're taking the forecasting out of the picture, and maybe you're doing it. Now, you could also say, you know what, I'm nervous about the election and I'll wait. It's 30 days or so to the election. I can't remember the exact number. Maybe we're at 36. You could conceivably wait that because it's just 1 month, so not a huge amount of time. But then I would be clear that, that day afterwards, you're going to put money in the market versus waiting. Well, maybe all the ballots have been counted, so I'll wait longer. You really want to have the set dates where you're just being systematically putting it in on, and that's really the big thing.
Thank you.
Well, thank you for the excellent segue, Charles. I just wanted to share the results of our little election here on what the official name of the AAII Way project should be. And just about 207 people participated in this poll, and it looks like 46% have said that they would like the name to be the individual investor wealth building process.
Well, Peter, our marketing director, is going to be happy. That's what we had chosen to go with it. John, any comments on manifesto you'd like to
That's my
share?
personal favorite, but I only get one vote.
We did have somebody in the chat comment that they voted for the longer name, but they said that the AAII Way had it was unique and had intrigue. So something definitely to consider.
Absolutely. Well, we certainly appreciate everybody participating in the polls, and given the questions too. It's a different format, but we do hope that you enjoyed it and found it beneficial.
Yeah. So I know you're showing this on the next slide, but I just wanted to remind everybody where can people find the AAII Way stuff on our website?
Sure. So you can still go back to our site. Going to AAI, just click on AAII.com and go to AAII.com/AAII Way. But we are going to be coming out with a new tab on our website, a new menu option called Learn and Plan. You'll be seeing that very soon. And we'll actually be expanding on some of the things we've been doing with the AAII Way so far. More interactives. I'm in the process of actually filming some videos as well. So as we build the process, you'll actually be able to find that on a new tab, and it'll have a new home where you can find everything for the project we've been calling the AAII Way, and going forward we'll be referring to as the individual investor wealth building process. But feel free to call it the individual investor manifesto. John will be very happy if you do.
Well, I'll be happy if everybody just simply follows a good plan and is able to stick with it in good times and bad.
Absolutely.
Speaking of plans, Charles, if our audience had some plans for the upcoming weeks, we do have some excellent webinar Wednesday content coming up. Next week, we are featuring Craig Israelson on retirement portfolio analysis, a multi-decade review. That's at 7:30. Apologies for the folks who are hoping to watch the VP debate, but I can assure you that our content is also very interesting. The following week, we have Mavane Faber on, talk about A Tale of Two Tales, The Melt Up and the Bear. That's on October 14th, same time, 7:30 Central. I've seen a preview of the presentation. It looks very intriguing. On October 21st, we have Chris Pedersen on simple and effective balanced portfolios for lifetime investing success. Those of you who watched the Paul Merriman webinar a few weeks ago, this is the follow-up to that, and we'll be expanding on the ideas shared there. And Charles is going to be now updating us on the newly named individual investor wealth building process at the end of October, October 28th, 7:30 Central, right before Halloween. Hopefully by then you will have considered some of your investing plans, and hopefully it will be more of a treat more than a trick. So anyway, I wanted to thank everybody for attending tonight's webinar. Replay of the presentation will be available tomorrow on our YouTube channel, along with links to tonight's handout and to some of the resources discussed. We'll be sending that to your email address. And yeah, with that, I wanted to thank both Charles and John and our audience for their time tonight. And with that, we wish you good health and good wealth. Good night.
Thank you. Good night.
Night.